This is Trace Miller, your host of Tips and Epiphanies from 3 in the morning. The quote that I'm sharing this week is, "The Energizer Bunny arrested, charged with battery." Charged with battery. Get it? I wonder if his attorney's going to argue that AA batteries is the same as a Class A misdemeanor. When a marriage ends in divorce, the lives of those involved are changed forever. During this time of upheaval, one of the things that shouldn't have to change is the credit status you've worked so hard to achieve. Unfortunately, for many, the experience is the exact opposite. Unfulfilled promises to pay bills, the maxing out of credit cards, and the total breakdown of communication frequently lead to the annihilation of at least one or maybe both credit ratings. The good news is it doesn't have to be this way. By taking a proactive approach and creating a specific plan to maintain one's credit status, anyone can ensure that starting over doesn't mean having to rebuild credit. The first step for anyone going through a divorce is to obtain copies of your credit report from the three major agencies: Equifax, Experian, and TransUnion. It's impossible to formulate a plan without having a complete understanding of the situation. By the way, once a year you can obtain a free credit report by visiting this website. Once you've gathered the facts, you can begin to address what's most important. Create a spreadsheet. For every open account, fill in the following information: creditor's name, contact number, the account number, type of account, credit card, car loan, so forth. The account status. Is it current? Is it past due? The account balance. Minimum monthly payment amount. And who is vested in the account. Is it joint, individual, authorized cosigner? Now that you have the information at your fingertip, it's time to make a plan. There are two types of credit accounts, and each is handled differently during a divorce. The first type is a secured account, meaning it's attached to an asset, for example, a car or a home. The second type is an unsecured account. These accounts are typically credit cards and charge cards. They have no assets attached. When it comes to a secured account, the best option is to sell the asset. This way, the loan is paid in full and your name is no longer attached. The next best option is to refinance the loan. Maybe one spouse buys out the other. The one buying out the other has to qualify for a loan by themselves. The last option is to keep the name on the loan. Now, this is the most risky because if you're not going to make the payment and the other person is, your credit is truly vulnerable. If you decide to keep your name on the loan, make sure your name is also kept on the title. The very worst case scenario is to be stuck paying for something that you do not legally own. In the case of a mortgage, enlisting the aid of a qualified mortgage professional is extremely important. The individual will review your existing home loan along with equity you've built up and help you to determine the best course of action. When it comes to unsecured accounts, you will need to act quickly. It's important to know which spouse, if not both, is vested. If you are merely a signer on the account, have your name removed immediately. If you are a vested party and your spouse is a signer, have their name removed. Any joint account where both parties are vested that does not carry a balance should be closed also immediately. If there are jointly vested accounts which carry a balance, your best option is to have them frozen. This will ensure that no future charges can be made to the accounts. When an account is frozen, however, it is frozen for both parties. If you do not have any credit cards in your name, it's recommended you obtain one before freezing all of your jointly vested accounts. By having a card in your own name, you now have the option of transferring any joint balances in your account, guaranteeing you that they'll get paid. Ensuring payment on a debt which carries your name is paramount when it comes to preserving your credit. Keep in mind that a 30-day late payment can drop your credit score as much as 75 points. It's also known that a late payment today hurts your credit more than a bankruptcy 5 years ago. It's also important to know that a divorce decree does not override any agreement you have with your creditor. So regardless of which spouse is ordered to pay by the judge, not doing so will affect the credit scores of both parties. The message here is to not only eliminate all joint accounts, but do it quickly. Divorce is difficult for everyone involved. By taking these steps, you can ensure that your credit remains intact. If you'd like to obtain a free consumer credit scoring booklet, please click on the link below.